Good morning, everyone, and welcome to the Sirius Report. Well, it's a new day, and despite one of the most dynamic policy changes that we've seen probably since 2020 and the reverse repo, nothing appears to really have changed. And this is something we're going to dive into because the underlying fundamentals are showing that Lehman 2.0 is still in play. Paul, as always, I want to thank you for being a part of the discussion. And boy, looking at what the markets have done today, you could almost forget of the Trump revelation regarding the tariffs and the delay. It doesn't seem to have really affected much at all.
Well, firstly, thanks for joining as well, Ken. So, yeah, we thought we'd get together and talk about the fact that in immediate kind of aftermath of the Trump announcement to pause tariffs for 90 days, unless you're China, the markets reacted in quite a positive way in the sense that the dollar began to firm up a bit. Equities pushed a lot higher. So, for example, the Dow went back to 40,900 roughly. Oil started to go back up in price, and the market started to reverse also a little bit with regards to the yields rising on the 10-year and the 30-year, for example. And we come back to the point we made yesterday that the whole reversal of the tariff policy was to calm the markets because the risk was if it carried on. Lehman 2.0 was a legitimate concern. This is not fantasy world. It is legitimate because there was stresses and strains appearing in the banking system with respect to interbank lending, etc., etc. So we're not going to go over all the stuff we went over yesterday, but I'm just briefly recapping that point. Now, subsequently, and overnight, sort of European US time, well, the markets started turning again as though, in fact, Trump had never made the announcement. Now, I think this is partially because, in reality, for all the bluster, the whole Trump tariff policy thing was largely really aimed at China, particularly. Not entirely, of course, and because the tariffs are still in place with respect to China, the market to some extent is going, well, you may have paused it for 90 days for a whole raft of countries, but China's still on the table, and we have concerns about what that means in a broader sense. So one can then arguably say that the dollar, in terms of the DXY, the dollar basket, I'm not a big fan of it, but people use it as a figure of merit. What do we see today? That fell as low as 100.3 or 100.4. So whatever gains it made in terms of the dollar basket, the DXY, they were reversed. So the market, again, was dumping dollars for other currencies, such as the euro and even the yen. The yen continues to firm up, in inverted commas, to about 144. It's up about 2% today, which is surprising as well. And of course, then we have to look at the fact that the equities getting kicked again. So we'll use the Dow as an example. And that is down at nearly 2,000 points. It's down about 1,500 as we speak. But again, we're back to the problems that equities falling means for companies, company valuations, and why that's a problem. And the idea you can just abandon equities and not worry about it is, of course, a myth. And we'll maybe just go back into that a little bit in a minute. But effectively, all the metrics, and then we started to see the 10-year and the 30-year yields rise. So to all intents and purposes, the market looked as though it said, well, you've made this announcement, but we still think these problems are in play. There's no indication that interbank lending's eased off the suggestions of problems with liquidity, etc. Interestingly, and when we've seen the idea that tariffs were in play, um, then when the gold price started to fall, and this was because of margin calls. Now, interestingly, the market has actually regarded the tariff statements Trump made to not be an issue because gold prices risen. It went to an all-time high earlier on, something like 31.75. Okay, silver, different thing. It's kind of bumbled around pretty flat, but gold was the one thing that logically uh, you would expect on a policy reversal to do what it did today. Everything else did the exact opposite. So what does that imply? Well, the policy reversal, everyone went, well, we're still going to pile into gold. So again, that means investors are buying gold and they are buying physical gold. Okay, there's the ETFs, but they are buying it and they're paying, well, for argument's sake, in dollars, but not exclusively. So again, there's an indication of weakness in the dollar. And for me, this is a further indication of what you would never expect to see in all this market uncertainty is the dollar weakening, the people dumping treasuries, equities being dumped, US assets being dumped, dollar denominated assets being dumped. So people are piling out the dollar through a total lack of confidence. And again, it's another indication of what de-dollarization has been doing, why the dollar is no longer regarded as a safe haven, why gold is increasingly regarded as being a reserve asset as opposed to US treasuries. And this is a statement of fact. What we're seeing is exactly what's playing out. And it's unprecedented because if this was any other point, say even 4 or 5 years ago, you would have expected to see the dollar index at 110. You would have expected to see the yields on the 10-year and the 30-year fall sharply because everyone would have been piling in to what they regarded as a safe haven, and they're not. And I think it largely comes down to the fact that if you are the custodian of the world reserve currency, then you have an obligation not to abuse it. You have an obligation to have trust built with the rest of the world. And the world doesn't know what Trump's doing from 1 minute to the next. I mean, he might say, I'm going to pause the tariffs for 90 days, and in a week he could change his mind. In 2 weeks, he might come out with another different policy. He might bully another nation and threaten to steal it, like Greenland, etc., etc. He's made all these bombastic statements, and even allies are going, not sure we can trust the US. The global south doesn't trust the US, and trust is the ultimate currency in the world. And if once you've lost it, you're never going to get it back as a world reserve currency. And this could easily spell another nail in the coffin lid of the United States being the world reserve currency. Time will tell. And okay, this is a snapshot and maybe the markets will change, but we're commenting in real time about a potential crisis, which is a reality. And that's why I think it was useful, just as this kind of introduction, to go back a little bit over old ground, but just to re-emphasize the point why Lehman 2.0 is still in play.
You know, after yesterday and what was going on, and then taking a look at the number of different things that President Trump has been focused on, tariffs, the trade deficit, take out all the bombastic rhetoric about the U.S. has been cheated and this and that. I was quickly reminded of something that came out about a decade prior to Nixon taking us off the gold convertibility, closing the gold window. And that was the Tiffin paradox or the Tiffin dilemma. And inevitably, in this book, of which he later spoke at a congressional testimony. He said the privilege of becoming the world's reserve currency would carry both a privilege and a heavy penalty. And that heavy penalty is this: to supply the world with dollars, the U.S. must consistently run a trade deficit. Running persistent deficits, the U.S. would become a debtor nation. So it's almost like Trump is like Don Quixote going after this big windmill of the global reserve currency and U.S. dollar hegemony. He wants his cake and eat it too. He wants the rest of the world to suddenly reverse and have the U.S. become the creditor nation to the world, while at the same time, if that happens and all the dollars come back and all the treasuries come back, which we're starting to see, inevitably it will bring down the entire financial system. Bretton Woods would be gone. The old world order that's been around for 80 years would cease to exist. And fortunately, there is the rise of the multipolar world, which looks at bilateral trade in one's own currencies, bypassing the dollar and not having to rely upon a singular reserve currency that can be used and manipulated and used as a weapon, etc. There is already something in place that is emerging in at least one half of the world that's inevitably, when this Lehman 2.0 event comes, which we're starting to see the underpinnings of, China and many in Southeast Asia, the ASEANs, all those, the BRICS who have joined into this system are already going to be prepared for the inevitability of the conversion.
Well, yes, and that's part of what's been going on, and we've talked about this for years. Well, for me, for 10 years, or maybe slightly longer. And this is all part of this big puzzle and the pieces coming together. I mean, the question is, somebody clearly picked up the phone and spoke to someone in the Trump administration and said yesterday, we've got a huge problem, Houston. You're going to have to do something about this. And they tried to do something about it. It clearly isn't working now. There are various ways for market intervention to try and deal with this problem. They're not going to just take this lying down and just allow it to happen. They will do everything to try and prevent it because they have to. There's an obligation to do this. So how long are they going to be prepared to allow the current market conditions to exist without the risk of a serious problem developing? And it might not start in the United States. It might start in Japan. It might start in Europe. It could start in the UK. I mean, gilt markets are also precarious. This is not a unique problem to US treasuries. So the question, therefore, is what can we expect to happen? Because if we were to wake up today, tomorrow, or whenever, and Lehman 2.0 happened, it would be, given we've been talking about this, it would be absolutely incredulous to imagine that would just happen without anybody noticing. Somebody knows something. They're not going to talk about it. They're going to keep quiet about it. But they will inevitably have to do something. And they may have to take some emergency action to avert a potential financial crisis becoming a contagion problem. But we're going to discuss other aspects of this in subsequent podcasts because there are many different angles to this. And I don't want to put it all in one, because A, it takes too long, and B, it dilutes the importance of and relevance to these different facets to what's going on. Tomorrow might be a different day. We're not disputing that. But the market has not responded how it was supposed to respond. I think one may actually argue, given all the contraindications and the fact gold reached an all-time high in dollar terms, is actually reinforcing also the concerns by people and going, well, I'm piling into gold again. I mean, and gold dipped below 3,000. It's now, say, a record high in a matter of a few days. That shows that the gold is not relegated again to an also ran and irrelevant, as people were trying to make out. There was a lot of margin calls. Silver has worse margin calls. The other thing is there's risk of more hedge funds going to the wall. And therefore, there has to be the brakes put on this somehow. If the tariff policy doesn't work, then there might have to be market intervention. But one could also argue there may be someone somewhere who goes, look, enough is enough with you. You think you're going to stick it to China. You think you're going to take them to the cleaners. Well, it's not going to happen. Here's what you're going to do. You're going to pick up the phone and you're going to bring an end to this. You're going to find a resolution. The Chinese have said they're happy to talk, but they're not going to be bullied by a US tariff barbarian, tariff wielding barbarian, I quote from the Chinese. They're not going to put up with this. So you're going to have to bite your tongue. You're going to have to, do the right thing, because we cannot be in a situation where we're having to pick up a complete mess because you've got a vendetta, or people in your administration have a vendetta with respect to China. That is not acceptable, because Wall Street does not want to be blown up for the reasons we've stated previously, because there's a lot of money that will be just flushed down the proverbial. The other thing is, many companies will start to suffer huge problems very quickly. And Wall Street doesn't take them very kindly to having their gravy train disrupted. I know Besant made the point the next 4 years is about the people. Well, you can say that, but Wall Street isn't going to agree to being taken to the cleaners and flushed, particularly not at the expense of the American people, whatever any US official thinks. That's not the reality of how it's going to play out. So we'll comment on this further at the appropriate time. But from my perspective, I think there's nothing else really needs to be said at this point in time. But it's important to give an update, because people may be under the impression that the markets are all fine, everything's calmed down. What's the problem? Well, the problem hasn't gone away. In fact, nothing's been resolved. Tomorrow might be a different day, of course, but we're just highlighting what the issues are, and someone may have to step in and intervene, or the Trump administration may literally get forced to abandon this tirade against China and do the right thing and say, okay, we're not happy with the current trade imbalance, but we're going to do it in an adult, mature way.
Something you mentioned in that last statement reminded me of something important. A lot of the money managers yesterday, of course, before Trump reversed his policy, were out there screaming on business media, "Oh, woe is us," et cetera, et cetera. Well, I am reminded that just about a week ago, and I think I mentioned this in a different podcast, is that there is already discussions being made and being suggested to the Federal Reserve that they may have to set aside a fund to bail out hedge funds. So are we looking at, Dario has mentioned about some of the banks going on in Japan. Are we looking at some of the hedge funds that have intrinsically tied to whether the assets or the derivatives in the system itself that could be catastrophic, i.e., more back on the premise of Lehman 2.0? Are we looking at many different factors? And it's something that we don't have full information on, but we're starting to see key pieces get introduced that hedge funds may be much more applicable to a financial crisis than in 2008 when we had the banks, et cetera, et cetera. Paul, as always, I want to thank you for being a part of this discussion and for your insight.
Yes, and likewise.
And to everybody here at the Sirius Report community, thank you for all of your support. Don't forget to like, share, subscribe, comment, send this out to anybody you think it might be important to. And until the next time we get together, have a great day.